Hello, everyone, and welcome to Market Week in Review for the week of January 9th, 2026. My name is Bei-Chen Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. Today, we have three topics to cover. First, equity markets globally are once again hitting all-time highs. Second, we'll take an in-depth look at the U.S. labor market. And finally, we'll wrap up with a look at inflation outside of the U.S. So let's get started. It's been barely a couple days into 2026, and once again, we're already seeing equity markets smash through their previous all-time highs. Whether it's the Dow Jones Industrial Average in the US, the S&P TSX Composite in Canada, or the TOPIX in Japan, just to name a few, we're seeing signs of pretty strong equity market performance this past week. Now, in terms of some of the drivers of that strong equity market momentum, from our perspective, one of the key factors is expectations for strong corporate fundamentals. The industry consensus is expecting earnings growth that is double digits year over year, not only for U.S. companies, but also for companies outside of the U.S. in 2026. And we think that that strong earnings growth expectation could potentially be attainable. One of the themes that we have previously written about in our global market outlook is this idea that the global economy is transitioning away from just pure resilience, but instead towards a potential reacceleration. In 2025, the global economy was still trying to navigate how to deal with some of the potential headwinds from changes in U.S. tariff policy and changes in U.S. immigration policy. But now, as we head into 2026, for the remainder of 2026, our expectation is that the global economy will likely see some of these previous headwinds fade away, and instead, some of these tailwinds from things like the ongoing and increased adoption of artificial intelligence, or things such as the U.S. fiscal stimulus that was passed in the most recent budget bill, that these tailwinds are going to start to outweigh some of these headwinds and be a positive for U.S. and global growth. Now, we are generally optimistic about the economic outlook globally for 2026, although economic performance is still likely to vary somewhat by country. We expect the U.S. economy to generally be in good shape for 2026, with growth outside of the U.S. potentially being a little bit more vulnerable to risk, but once again, generally our expectation is that 2026 is likely to be a better story globally for the economy than 2025. Now, despite the fact that equity markets are at all-time highs, we haven't yet seen signs of euphoria just yet. And this is very important because from our perspective, as long as markets have not yet hit euphoria, there's still the potential for equity markets to potentially continue grinding higher. And so that's one of the reasons why we still think investors would benefit from staying close to their strategic asset allocation instead of trying to tactically underweight equities just because equity markets have gotten to all-time highs. Next, let's talk about the U.S. labor market. The key data point that's going to be released this week is the non-farm payrolls data in the U.S. on Friday. Now, we're filming this episode before the release of that data, but when we look at other key labor market metrics, like, for example, the private sector job creation data from ADP or Revelio Labs, as well as the weekly initial jobless claims estimates, we're seeing signs that the labor market in the U.S. is still holding up. Now, even though job creation has likely slowed from where it was in 2024, it's important to keep in mind that the pace of population growth and therefore the pace of labor force growth in the US has also slowed. And what that means is that it no longer takes as big of a monthly job creation number to be able to maintain the same unemployment rate. So our expectation is that the U.S. labor market, generally speaking, is still likely to be in a healthy and roughly balanced spot for 2026. Finally, let's wrap up with a look at inflation outside of the U.S. This week, we got inflation data for both Australia and Europe. In Europe, the latest inflation data shows that inflation is still around the central bank's target of 2%. And so we think that the European Central Bank will likely continue to remain on hold with their key interest rate at around 2%, which is our estimate of the neutral rate of interest. In Australia, we saw inflation edge lower on a core basis and inflation edge lower as well on a headline basis. Nevertheless, inflation in Australia is still above the Reserve Bank of Australia's target, but we think it's a little bit too early to be thinking about rate hikes in Australia just yet. Meanwhile, the market is pricing in some rate hikes in Australia. So against that backdrop, we think that there's some good value in Australian government bonds. Thanks so much for tuning in. We'll see you next time on Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.